Okay, good morning, everybody. Jay here from smarthelping.com. We're going to continue on the property management business financial model, thinking about how to structure revenue. I don't know how far we'll get today, but we got really far last week on how all this is going to work, and it's pretty cool. Before we get into this, remember this property management template will be listed at smarthelping.com. It actually fits into a bunch of different categories, so it's going to fall into the SaaS category as recurring revenue software because the property management business is going to run software to collect rents and all that stuff. It's obviously part of the real estate category. It's part of the industry or startup models category for sure, and I believe that's it. And service businesses. So it'll be in all of these. Remember, you can check out all the financial models at smarthelping.com under the financial models tab at the top, and you can buy everything for $9.99. That's lifetime access to all present and future templates that ever get built. Let's do a sound check. Test. Test. Okay, good. Word there for a second. Live financial modeling, property management biz, part 3 today. Okay. So let's try to recap because I haven't looked at this since, well, Wednesday. Uh, so we have global control, just some general assumptions about timing. It's up to a 10-year model. Okay, so this was interesting. I've never done this type of driver for customer acquisition, but essentially what this model is saying is the annual customers added goal. Now, a customer for a property management company is essentially a landlord or somebody who owns properties that need managed. So that's a customer. What we've done here is said, what's our annual goal of customers to add, and what percentage of that goal are we achieving over each 12-month period? And we could put month number here. We could do a year number just so it's easier to use. And then I also did some conditional formatting in, I believe, oh wait, wait. 10. We have all of our logic here for the matrix. I thought I did something with conditional formatting, so it was easier to see each 12 months period. Let me see here. Nothing on those. Nope. Was it a different template I was on? I really thought I did. Well, all right. Anyway, it's neither here nor there. We have you can define the percentage of the yearly customer goal acquisition that you attain in each month over time. That will give you the clients added. We have now each client or customer, again, is a property owner, and what we've defined here is the average unit count per customer that gets added. So let's say we add one in month 1. They have 25 units, and on average, the starting average rent per client monthly is 35,000. So it's saying these 25 units are driving $35,000 in revenue, and that's what's being managed by the property management company. Now we did 3 different revenue structures. We did percentage of rent, flat monthly fee, or per unit fee. Now, from all the research I've been doing, the most common way seems to be just a collection of the percentage of rent under management. But the flat monthly fee could also be something where you're charging each customer on average some monthly fee, whatever, and that's going to depend on your types of customers that you're getting. This is not really variable though, so you could do this if you plan on if you can break down your customers into a weighted average, essentially amount that you want to charge per month. Um, so it's not as common, and then the per unit fee is essentially a bit like the monthly fee, but is more variable because this will be dependent on the amount of units under management. So this one could be useful. This one's definitely useful, and this one is less as flexible, but still we're going to put it in here. So that's how the main property management fee is going to be collected. Now we went on Wednesday and we're looking deeply at all these other revenue streams. So we've got a one-time sign-up fee, which usually when you sign up a customer, the property management company is going to charge some kind of onboarding fee to get the landlord all set up with all of the technology, whatever is involved in implementation. So there's a fixed one-time fee. Um, we also have potentially a secondary revenue source called repairs and maintenance monthly fee. Now this is based on the amount of units and it's just a charge per unit, and that's going to be related to the cost per unit as well. So, and I don't know if this is the best way to do it, but there's got to be some way to say one of the extra services that your property management company might supply is um, repairs and maintenance. And if they offer that, then it's going to have to, the property management company is going to have this cost and they'll have this extra revenue stream. Now, what you'd have to do, what what I would probably do to make it easier to understand what the numbers mean is break down this total, what this total revenue source is and what this total cost source is of repairs and maintenance, and divide it by the current customer count, so you can figure out on average, per month what your maintenance costs are, and then you could divide that by like a head count to figure out if that makes sense, if the economics make sense. And then we have application fees. So this is where we get kind of tricky. So these revenue sources are definitely, we need to account for them because a lot of property management companies will take application fees. And so you have a one-time fee, you have the percentage of newly um, onboarded units requiring applicants. So let's say you sign on these 25 units, they all are going to have to be filled out. Let's say it's a landlord with a new property, it's getting customers or a tenant for the first time, and this application fee is charged. There's multiple tenants or multiple potential tenants can apply to the same unit. So there's a revenue source here upon initial sign-on, which might be different depending on if the property is brand new or not. Now there's another part of this where there's application fees for ongoing, and what this means is essentially, as you're managing these properties, people are going to be coming and going from tenants are going to be coming and going over time. So there's applications that have to happen. So what we're saying is on average, what percentage of the units under management are requiring new applicants? So let's say it's 1%. So if you had, say, 500 units under management, then you're saying on average every month, 5 units are being turned over, and those 5 on average have 3 applicants per unit. So every month that would be on average, $750 a month based on those assumptions. And then this is going to apply only to the initial onboarding of the units, and then this is going to apply to the units after that first onboard month. So we're going to have some dynamic logic there. And I believe that's enough. The repairs and maintenance structure and the application fees, one-time sign-up fee, that's going to cover 99% of property management companies. And then you've obviously got the standard monthly or regular property management fee. Now, this regular property management fee might cover some of these other sources. So you might have this, you might have some of these other costs, but then you don't have the revenue here because it's all built in. And that's fine too. And that's why this is, I'm trying to build this as flexible as possible. So let's see. I believe this is good. So let's start building this out. So on our matrix here, we did, what did we have? So this is the customers added. We've got their age, which is going to be important for the application fee assignment. We have the age in year. Start month. Rent under management, which is huge. So this is the amount of rent a given cohort of customers added is going to produce over time based on the growing. And we have a rent growth here. We have a retention rate on the contracts for customers that are signed up on your property management company. And then there's also average rent growth. So the properties you have under management likely are going to go up in rent over time, so we're accounting for that. So that's good. Retention, customers remaining. So these are the total customers remaining, which is going to be relevant for this monthly fee. And then these other ones, the percentage of rent obviously is based on the rent under management, and then the per unit fee we have to account for, which is this, and we have units under management based on the amount of units of each customer cohort that's added per month and how many units that is. And then that's going to be obviously important for the per unit fee. So we have this. This is good. Okay, so that's great. I believe we can start on our P&L cash flow. So let's pull up a monthly detail. Let's get some standard formatting. Let me just pull up a past template here. The sports agency. Hope everyone had a great weekend, by the way. Getting into the Christmas spirit. Yeah, this is actually a 5-year model, not a 10-year. I believe a 10-year model is important if your business takes a while to stabilize, but for businesses where, um, like a property management company, stabilization within 5 years, you're going to be able to see most of the unit economics. It's not really going to be, you'll get the picture within 5 years. So we're going to keep it like that. Okay. All right. So how do we want to structure the monthly detail? Well, first we want to put the highest level information at the very top. So that's going to be um, probably, let's put customer acquisition. And we'll do new customers added, customers lost, ending customer count. And remember, customer would be your landlords that are contracted with your property management company. Now these calcs will be used for a bunch of different things. Let's actually freeze this one column back here. Okay. So new customers added is simple. We have that right here. That's already being calculated. Customers lost is a little tricky, and ending count will be, we have it calculated here based on what's remaining against the retention schedule. Now, if you put decimals here, you can see a little bit better on a given cohort. What's happening is we're saying, what did I say, 90% retention every 12 months. So the value of one person signing up is 1 in the first 12 months, and then it's 0.9 in the second 12 months, and then 0.8, 7, 6, and so on. We only get to 0.6. And so what that's represented is a probability the customer is still going to be a customer over time. And so that's why the decimal is completely fine there. It doesn't have to be a whole number. So let me see if we can calculate, if we know this end count. Can we automatically calculate what customers were lost without having to do anything else advanced here? Now I may do a second cohort. So this is like one type of customer. I was thinking about possibly doing a second one, which would, the main reason for that is if you want to say have two channels, like, okay, here's the types of landlords I want to sign up that have, this revenue structure and all of these assumptions. And then I want to do a second type. And the only thing that you can vary these by month, so that's not necessary to have, but if your percentage of rent you're collecting varies or whatever, it could be relevant to have a second configuration potentially for other, if you want to say, these are property types in this region, then these are going to be property types in another region that you want to manage that have different rents or revenue logic or whatever. So just to go from 1 to 2 is a pretty huge leap, and then every time you add from there, you're only incrementally larger. Like you go from you're doubling to then adding a third, and then the adding more gets less and less valuable as far as the model goes for functionality. So we might do one more. I just got to see how difficult or not it's going to be to get all of this, because some of the stuff is obviously not modeled yet, so we got to figure it out. But I think we could probably do another one. Let's just see. So here's our ending customer count. Now, customers lost would essentially be ending count less the beginning, maybe, or beginning. Let's think about this. We start at 0, we add 1, something happens, then we have this many left. Let me put decimal so it's easier to see. Actually, let me just make this number bigger. Let me put this to, let's say, 100. Okay, so we have 10. Now, we're not going to lose anybody till the 12th month based on these contract terms. Like, if this were 6, then we start losing after month 6. There's some stuff going on here. Let me add a beginning customer count. So this is all encompassing model, so this is always 0 to start things off. And then this is relative to what you're putting on the assumptions. We know what this number is, and then this is just whatever that started at. Okay, so can we work into customers lost without having to go back to the matrix schedule? So if I know we started with 20, we added 10, and we have 30 left. All right, let me make this a little bit bigger. Do 1,000. Okay, so And we'll be able to see this after month 6 based on the 6-month term. So if this calculation should technically be what difference we need to get to 690. So if we do this plus this minus that, 10. Okay. So it's 0, 0, 0. Then we start to have attrition. And it's 10 per month because we're adding 1,000. We're adding 1,000 customers. We're adding 10% each time, which is 100. Our retention is 90%. So that means every 6 months we're losing 10. And if I were to put this to 12, then every 12 months we're only losing 10. Which you'd have to extend this out to see. Okay, so this makes sense to me. We can drag this over. All right, and then eventually, so we're not adding customers, we're still losing some. Now, why does this go to 0? Why are some of these months, why are we not losing anybody here? It could, oh, I know why. Because we have 10% added in the first 10 months, but then those last 2 months don't have anybody. If we were to say, take, an even amount for the whole 12 months, then this should be even. There's no gaps. Okay, good. I just want to make sure the logic's good. So that's fine. Okay, so that works completely fine. Now, what's important is this number here. Any customer count we're going to be using for a couple of calculations, potentially, well, mainly the charge per month fixed amount. Give this a little indent. All right, so we have here's our customers that exist. Let's go back to our initial 10 per year goal. We need to know unit counts next, so we'll do customers, and then we'll also have do I want to do units as, I guess we have to. We could just actually go ending unit count. I believe I'm trying to think if any of these assumptions require us to know the total units added or lost. I think we have enough information on the matrix. We just go ending unit count here. A lot of guys will measure their property management company based on units under management. That's very common. So, and it's used for some calculations as well. So we're just going to reference that here. We have all the dynamic logic working. Okay, so unit count. Now, okay, now we figure out what money we're actually making. And I would need these to be light bordered, not hard bordered. Oh, it can't do it if it's just one. Okay, so we'll just do bottom. Okay, that's fine. All right, so we have customer acquisition or customer. Let's just put customers. So this is what is happening as far as, what is the business adding? And then we have revenue. And again, let's just say, so customers type 1. Just so I don't forget if we end up adding a second type, which I believe we will do. And then revenue. All right, so revenue, first of all, we need to know property management fees. So we have three different options here. So let's build each one out. So we already have we have total units under management, which is going to be used. We have total customers under management, which is going to be used. So we have these two that are already, we just have to multiply. But we need total rent under management. So let's put that as the first thing, rents under management. And that will be this here. Let me make sure this is formatted right. Perfect. All right, so we know how much we have under management. Our property management fees will be, we'll just do three ifs here instead of doing three different things. I think this is most efficient. So if this equals flat monthly fee, then take the flat monthly fee times the customers, not the units. And then if this equals percentage of rent, then take the percentage of rent times rent under management. Okay. And let's make sure these are all got to be locked here. And then finally, if this equals per unit fee, then take the per unit fee times units under management. So there's no hybrids here. It's either option 1, 2, or 3 here. And so that's the revenue. That's the main revenue source. Okay. And right now, what do we do? A flat monthly fee, if we were to do percentage of rent, it's now that, which makes sense. So this divided by this should be 5%, 5%. And if we were to do a per unit fee, now it's, let's see, this divided by here, it should be 5, yep, 5. So you can either charge per unit, flat fee per customer, or percentage of rent. Now you have other revenues. And other revenues we have are onboarding fees, application fees. I think that onboarding fees, oh, and repair and maintenance. And remember, you don't have to have all these fees, or you might have those fees built into your property management fee. What this model will let you figure out is based on your customers added, units under management, how much revenue that's creating against the costs, which are mainly going to be you'll have fixed overheads as well, which we haven't built in yet, but those will be. But you'll have these variable costs, which are you're gonna have to make sure the revenue you're collecting is more than that, or else you'll be running at a loss. So that's a really important aspect of this model. I think we'll definitely add a second configuration type as well. And what that means is we'll have different variable costs for each type, but that's not too difficult to build. Okay. So this is good. That's all working. Just looking here at this logic. Okay, so we're pulling the start month revenue. Got it. Okay, that's good. So if I were to say this were 100% retention, and we added this one customer only, then we can see, so they're $35,000 in rent. Then it goes to 35.7. That should be a 2% increase, I believe. Yeah. Okay, so I just want to make sure this is working. 35, 36. Okay. So that's going up. The age in years. Now the age in years is really relevant for the rent growth calculation, so we can do that dynamically. Okay, this looks great. What else do we got? Oh, yeah. All right. So other revenues. Onboarding fees. That's a simple calculation. We just say new customers added times onboarding fee. It's only charged one time upon onboarding. So that's easy enough. Now, application fees are tricky. Maintenance fees are easy. I think, what do we do based on unit count? Yeah, fee per unit. Okay, so that's fine. Oh, wait. Lock D31. Okay, so the hard one, application fees, we're going to have to do that in the matrix. So let's just drag this down. And because we need to know some timing here. Application fees. And this will be if the start month is a 1. Where's our age? If this equals 1, then we do, what's this logic? We do $50 times index. We're going to need to know the unit count of the onboard. If that matches our cohort. Which should be in here. So let's see, age, no, start month. I think that's our lookup value. What's that? B187. So that's going to be the month against month number. Okay, and then so D33 times the unit count added initially times this percentage times this number. And then we can lock this row. And this is all if that equals a 1. Okay, so 3750. Initial onboard fees for that customer. Now, what if it's greater than 1. So we got to do a second calculation here. If the age is greater than 0, then do this amount. Now this is tricky. Let me think here. So this is ongoing, right? So we just need the total. So that $50 times the onboarding is fine. We have units under management already. So actually we don't need to do an index formula. So $50 times, where's our units under management? This. All right, so the application fee times units under management times percentage of those needing new applicants times the applicants per unit. And that's about as deep as you're ever going to need to go here to get reasonable assumptions. So we should see a number going across the top. Wait, what? We should not be getting an error here. So if this equals 1, that. Otherwise, if B187 is greater than 0, do this. Otherwise, 0. Now this is, something's wrong with the formula here. If B6 equals 1, then do this times that. Here, this should not be double close. Oh wait, yes, we're still in the value true. So this times that times that. Otherwise, if B187, okay, so this is not the age, this is the start month. We want the age in months. So we want B63 for the second one. There we go. Now it should be going across. Yep. Okay. Perfect. All right, and that's pretty much it. That's all the revenue assumptions. We'll bring that in over to the monthly detail. Now, if we were to add a second customer in month 2, you can see now here's the second customer, here's the application fees, here's ongoing fees for that. Let's say the retention rate is 90% in their 12-month contracts. Now you can see what that value is over time. Okay. This looks good. Let's bring that into here. Get the formatting, application fees. And then we have total other revenues. We'll make this. We need to lighten up these lines a little. So that's good. There we go. Okay, let's drag this over. Okay. So here's all of type 1. Here's your revenue. This is pretty good. We'll have to do variable costs and oh wait, we did repairs and maintenance. We'll have to do variable costs and then let's think about type 2. What's going on, guys? Welcome in. Um, let's see, just making sure we didn't miss anything. I think we're good. So we'll copy this over. We'll do one more. So 1, 2, 3. And let's give this a title. Type 1 customers. And type 2 customers. Now this might not be relevant. If not, you can always zero it out. But I think having two configurations makes the model twice as usable and it'll fit more use cases. So we're adding it. Um, so going back to this, we just copy this down. We'll call these customers type 2. Well, essentially everything that's type 1 is going to type 2. Type 2. And then we'll have to do a consolidated type 1, 1, 1, 1. Oh, this is 1. Okay. And then, yeah, we'll do a consolidated. And now these are no type. This is just total. All right. That should be enough detail. So let's build the logic out. So we have this was all type 1. We make a copy. And now we just reference all the stuff on type 2. So let's make these, let's say a little bit bigger. Let's say we get 50% in month 1 and 50% in month 6. Now the question is, what in the world was I? So if we do, let's say we get our full goal here. Now if we start over again, we have 110. We need to make this formula needs to be a little bit smarter. So here to make it dynamic, we'd simply say sum ifs, the total percentage added in row 7, if the year matches the year here. And we need to actually, we got to put this in. And then lock, so that's fine. Lock this, unlock this and make it E as well. Now I believe that should make sense. So let's go to 12. Nope. Oh my goodness, what happened? E2 to E, E7 to 7. Try this again. There we go. So this is a cumulative added per year. Then it starts over in year. So we get up to 100. Then in year 2, now it should start over. Perfect. So within a given year, it's going to tell you what percent you're at within the year dynamically. And that makes way more sense. Copy this, paste it down here. Same calcs. Let's see, this needs to come down here. This stays up. Okay, so 50, then let's say 50 there, it's 100, and then in year 2, oh, wait, year 2, reset. Okay, good, so that works. I like this new style of customer acquisition defined by a percentage goal per year and then the percentage of that goal reached. Um, and if you wanted to raise it, you could obviously just put a greater. So for year 2, let's say you wanted to do 120% of this amount, then you could just put in for 13, 120%, and then you're adding 120. So that actually works fine for scaling too and growing. You don't have to have it equal 100%. Put that there. Okay, all right. What else? Oh, let's see what this looks like if we did like something like this. And just I want to make a way for it to be easy to see what year you're in. And we might be able to do it with conditional formatting with color scales. Let's see. Hold on, undo. Let's do the other way. So that was white. What about that way? So here you can see your progress each year, like how close are you getting to your goal each year. Based on what year you're in. Uh, let's see what this looks like if we do, what's the easiest way? Maybe alternating like a light gray every other year. So there. So now if you're in here, you can kind of see the cutoffs easier. Okay, yeah, I like that. So let's copy this. Actually, we could just reference this. Okay, so cumulative goal reached per year. All right, Anyway, so we have 100. Let's say these are 10 unit things. They're bigger rents, so that may be 60,000 a month. All right. We're not increasing, well, the percentage of rent charged will stay the same throughout the 5 years that you're collecting, but the rents could go up. The flat monthly fee is not changing over the 5 year period or the per unit fee. But what you can change over time are the unit counts of the customers you're adding to your property management company and the monthly starting revenues of the units under management. We're not doing occupancy. So when you're doing this rent under management, this should be whatever is contracted to be the value of the rent when you sign on the customer for whatever unit counts there are. Okay, so we have our setup for type 1. Let's put in here, give it a little text thing, type 1, and we'll just label this equal to this, whatever you want to call it. So type 1, let's rotate the text. Where's my format? So let's put it 45 maybe, a little bit more. 60. Okay, so type 1 customers. We have type 2. Oh, shoot. Type 2 customers. And then consolidated. I wish this underline didn't go through the whole cell here on other revenues. Why is that going the whole length of the thing? I do not know. Okay, so the main thing we need to know, let's go to the matrix. So this is the most important thing to get right first. So counts, we have revenue assumptions E9 is now being changed to, so that was this. We now go to 47. And it's very important that I get the right references here so that the model is accurate. And let's look back here at making sure these look good. So this is kind of a scale up one, two. Okay, good. This looks great. Looking good. Make sure I don't have any comments. Right, so that's the count. Then we have age, so that's just a dynamic reference for the cohorts. That's all fine. Same thing here. Now wait a second. Oh yeah, age in years. Okay, that's good. Okay. Start month. That's going to be used for a couple different calculations. Now rent under management. So index, we had 13 starting average rent per client. So that needs to be for type 2, 51. So change this from 13 to 51. Let's see, max of 187. So that's the start month against revenues. Okay, times B 374, which we haven't done yet for this one, but that's fine. So right, units or customers added per month times units per customer times 1 plus and D19, so that's the rent growth. And that's changed here. 19 average rent growth is 57. And that can be drug over. Okay, looks good. 27. Okay, great. Now, why is this higher? Oh, 6. Right, because we're adding all these at once for year 2. Okay. Make sure we didn't miss anything. Yep, good, good, good. This is fine. Retention. So now we have our second retention schedule. This is always 1. This is going to be this plus the contract length for, and again, these might be type 2 customers might have a different contract length than 12 months that you're signing up. Maybe they're 5-year contracts, so the retention rate is going to be varied based on that. So that's fine, whatever that is, and then the percentage will simply be based on the retention and then a straight line down. So this amount for type 2, and that's just perfect. So G to H is what we want here. So G to H. Let's change this just so we can see maybe they're 24-month contracts. So we should see 100% to 25 and then 90. Okay, great. Then if we drag this down, 90 here. Okay, looks good. 6 months. A lot of times to get the math right, you got to do cohort modeling for whatever you end up modeling. If it's something that starts in a certain time and then it changes over time. So that's the best in practice modeling we can do. So that's what we're doing. Now customers retained, so this is fine. This looks good. Because when you have that separated out, you can then add attributes and variables to a single cohort and then aggregate them to see the effect on the same timeline for multiple things happening, which is what we're doing here. Units managed. So this is definitely going to be different. So 11 here was average unit count, and this is 49. And revenue 3, all that rest of the stuff's fine. So units under management, right? We said lower units, higher rent per month. So there's unit counts. Rating 50 clients with 10 units per client, so 500 units under management for one customer. Or sorry, for 10. Rather 50. Oh, it's a Monday morning. For 50 clients, each having 10 customers, or 10 units, or 10 tenants, um, with $60,000 per month in management. Okay, so that looks great. Okay, application fee. So here, yep, we just did this on the other one today. All right, so D34 becomes, that's application fee on the first one. That's going to be 72. Just move right through this line by line. So 72, and then index. So 11 is going to be average unit per customer is going to be 49. That's fine. Let's see. D35 is changing to percentage. So 73. D36 is changing. Let's see. Average applicants applying per unit for the first one to 74. So 73, 74. D38. What's that? For ongoing application fees. Okay, so 38 is 76. That's dynamic. 39 is 77, I believe. Yep. And then 40, I'm assuming that's 78. Let's see, what was 78? Average of applicants applying per unit. 40, yep. Okay. So that we just covered all of this logic here and all of this. So there's the one-time fee, the ongoing fee. Now question, why is it only going in half? So we're 1%. Should be a lot less than half, I believe, unless I'm missing something. So this is 15. Because we're doing 100% of 500, and here we're doing, should be 1% of 500. Age 2. What am I multiplying? C63. If C63 is greater than 0, then do D76 times 437. Ah, wait, no, we did that. So 500. What's 500 times 77 times 78? This should just be 50 times 1% times 3 times 500. Okay, 750. Now the onboard should be $50 times 100% times 3 times 500. Should be 75,000. So why am I out by 1,000 times difference? Let's see. So if this equals 1, revenue D72. So 50 times 49. Wait. No, 49 is right. Average unit count per customer. Am I missing? Yes. Okay, good. I think this is good to see because on the top one I was just doing one customer, so it didn't matter. But if we have multiple customers, then so this one was right. The 750 calculation was right because we were doing 76 times the unit count under management here. But the first one is not. We have to do this times the units under management times that times customers added, which I believe is just going to be this one. Yeah, 50. So 50 is the customers added. And we'll have to add that to the matrix 1 calculation too. So that's tricky. Yep, 75,000. That's what I expected to have. Because in theory, you have 500 units onboarding right in month 1. And month 1, remember, is $50 application times 3 average applications per unit, and we're doing 100% here. Then it goes down to 1%, so 750. And then so the other one should be the same. Okay. And then this is 150 because you're doing 100% all in month 1 of year 2. Okay, good catch there. Good catch, good catch, good catch. So let's go to matrix 1. We got to update that calculation. So this, remember, we want to do right before the end. Multiply that first amount by the total customers added in that month. Because all we've done is we index the units added in that month, but not the amount of customers added, which would throw off the calculation if that were to change. So now if I were to say add, what if this were to be 25, 2.5? Yeah, so now in before, so here's with that calculation, 9,000 then 94.94. If I did not change the calc, it would stay at 3750 no matter how many customers were added, which is not right. So let's get the right one in there. Oh, shoot. Drag it over, drag it down. There we go. Okay, so now they're both correct. Good catch there. Good catch, good catch. I believe we have enough to do our customer type 2 and then consolidated revenue, and that should be a great Monday morning. It'll be pretty easy to do the variable expenses, and then we'll get into the fixed expenses and continue on with the rest of the model, which will mainly be financial statements after that. And then this thing will be ready to go probably next week. Welcome in, guys. Happy Monday morning. What's happening? Hope you're enjoying the day. We're just sitting here in the cold Ohio trying to do this property management model. Okay, so type 1, type 2. Just making sure this formatting makes sense. All right, so beginning customer count, that's just a hard code. This new customers added, we just reference our second type now. Okay. Now we're adding of the 100 goal, we're adding 50 in January, 50 in June. Customers lost is going to be just a fill calc, but the real calculation is happening on the matrix tab for any customer count type 2. We simply just change this from a 1 to a 2. Oh, and I'm sure the number is off, so any customer count 373. This is 373. Let me double check that. Customers lost 2373. Yeah, customers remaining. Okay, so that's good. Ending unit count. I'm just going to hard code right in here or just do it manually because I don't want to. So units managed that. And then we could check it against this. So it's 436. Perfect. All right, we have our customers type 2. Drag all these all the way over. Now, why are we losing customers here? 100, 100, 100, or we're not adding any. It's because we only had acquisitions for the first year and, well, the first 2 years. So we added 200, and then we start losing. Now, yeah, and then based on the 2-year contract terms and the 90% retention rate, every 24 months we're losing 10% of the initial added amount. And so if we were to add more customers through the whole 5-year model, which is normal you would see the number growing over time. But that churn is really important to put in there because let's say you're a property management company, you sign up all these customers. Well, they might leave. You might have a small percentage leave over time, but you're still growing and adding new customers, so that dynamic can be accounted for with this model accurately. All right, so customers added here. We did this. We updated this. Okay, so now let's do revenue for type 2. So rents under management, we simply reference our matrix 2. Rents under management is up here. Remember, these customers are bigger, but there's less of them. But their rents are 3 million versus 87,000 based on, well, depending on when you add the customers for the year and the size. So we're going 35,000 up to 60, but we're adding all 50 up front here. Well, half instead of just 10% here. So this number's bigger than the other one. Okay. Sometimes it's good when you're modeling just to look and see if what you're seeing makes sense relative to what you think it should be. So this is saying in the end, they're about 5 times less rent under management for type 1 versus type 2. Now, if we were to say these were the same, from percentage acquisition down, what happened? Undo, undo. Right, this is not one I could make go the same, so we have to do separately. This is a good check too to make sure the calculations are right. So if I make these the same, then I should see the same exact numbers in type 1 and type 2. Assuming, and then we also, 2, 5, 20, or these are 12-month contracts, 90% retention. Okay, so now if we go to monthly detail, these should be identical. They're not. 350, why is this still so different? 1, type 2. Oh, because the goal is 100 here and it's 25 here, so it's 4x. If this were 25, now, perfect. So these are the same. 53, 53, 6. Now, customers lost. Why is this becoming positive? That looks like potentially an error because this should be the same as this 1320, 1320. Why is this 0 and this not? See, this is how you can catch errors in these models too. Well, let's go back to the first month here. So, customers lost why are we losing here? This should be positive. We had one. Ah, okay. This is hard-coded for some reason. This should equal this. Oh, I think because I drug over the first column. Okay, so that makes sense. All right, now they're identical. All right, perfect. 16. Looking good. Okay, and then so rents under management. That's identical. All right, property management fee. So here's our big long hole calculation. So the best way to do this is let's copy this because we don't have any of the references locked. It'll be different anyway. So we just go copy paste and we just drag. So this ending customer count type 1, ending customer type 2, ending unit count, and rents under management. And then all of this stuff. So D17 and becomes revenue base. Okay, so that's going to be a big one used. So that is now D55. And this is also an interesting way to show if you want to show the same exact customer acquisition, but then if you're charging per unit fee versus a flat monthly fee versus percentage of rent, you can then run the same scenario but just change these variables and see what the revenue difference is between type 1 and 2. So that's just another good use of the model. And that's why it's so nice to have these models because you can hold variables in place and see if you change one thing, what happens. All right, so this is D55 replaces 17. So 17 is 55 now. For this, there should be 3 of these. Okay, and then D22 is now going to be 60. And I believe that just shows up once. D20 percentage of rent is now going to be this one in 58. And D24 was per unit fee, and that is now down here in 62. All right. Now, as long as all that's the same, this should be the same amount, 6,600. It is. Now, let's say we're changing this to, oh wait, this is a per unit fee. Let's say this was now a percentage of rent. You see the difference now, 98,000 versus 6,600. Let's just put them both to percentage of rent. They should be the same. They are. All right, so that's the main property management fee, all adjusted for type 2 references. Looks good. Onboarding fees. So this is easy now. We just go new customers added times type 2 one-time sign-up fee. Application fees is it's a dynamic one, which we did all of that math already. Remember that, and then we caught the error. So that's good. Repair and maintenance. Oop, which one was this? Yep, so ending unit count times average fee per unit per month. All right. Now let's look at, now we really, wait, why is this one a column off? Total, those should be the same. Let me undo this. Okay, so if I have, how many columns or rows are here? 14? 14. I don't know how that got too big. All right, let's make that only 13. Okay, 14, 14. Um, what was I gonna do here? So we have, oh, so we have property management fee, other revenues of this. You probably want something here that says total revenue type 1, which adds this together. I don't know why I'm trying to make this. Let's just undo, undo, undo. Let's just add a row here. So total revenues is here. We'll give this a regular bottom border, or top and bottom. And that'll make it easier to compare to. So we have total revenues type 1, total revenues type 2. Now they should be identical. We'll also give these a light gray because it's aggregate. All right, so we have that. Now consolidated, we simply just do type 1 customers plus type 2 and just drag it on down. It's just a accumulation of both of those. Same with this. Now let's see if that makes sense. It should just be double. So we got 12, 638 and 638. So 1275 roughly. And there's decimals in there, so there could be some rounding going on. All right. That'll work. This is a good cash flow management tool as well. Now consolidated revenue. We'll just put here in USD. Just so you know, this is revenue numbers. This is customer count. And this is all in, let's see, this is consolidated. Consolidated. All right. Do we add up all of these? Yep. Okay. So rents under management, we now do these two. This is that and that. Other revenues. And then we can just drag this down. Okay. And let's just make sure. So let's add total revenues consolidated as well. And now that will be this plus this. Which should also equal this plus that. Okay, looks good. And then it also should equal this plus this 280. Okay, looking good. Looking good. So we have all the way down to revenue type 1 customers, revenue type 2 customers. I think adding that second configuration makes the model exponentially more useful, and then I think it's not really relevant to add any more than that for the purpose of a default model. We can do two different customer configurations, compare them. There could be two customer channels, all the revenue shown here on the monthly detail and consolidated. We'll do variable costs tomorrow, variable expenses, get into fixed operating costs, and then go down from there. And we'll see. Model's turning out great. Again, I love doing models where the logic is new, and it's not new just to be new, but it's new because I've never modeled this specific business before. So it required some cool stuff here. I really like the revenue. Defining a percentage of the yearly goal attained for customers. And then this is all nice and dynamic. Um, very good. Very good. Remember, guys, you support me. Check out smarthelping.com. Uh, the model I'm working on now is actually going to be part of the SaaS bundle, real estate bundle, and startups bundle. And you can buy all the templates on the whole site for $9.99 if you want. And that's lifetime access to anything I ever build in the future as well. Tons of value there. We've got a lot of SaaS and recurring revenue models, real estate underwriting tools, startup financial models for all kinds of different industries, all unique logic, just like I'm doing here for this one. Joint venture cash flow waterfalls for this is mainly for real estate, but it could be used for other businesses. Accounting and finance tools and trackers. This accounting system is one of the most interesting things I've ever done for use for accountants to build financial statements based on a transaction log. It's pretty cool. Human resource trackers and tools, personal finance tools, Google Sheet architectures, and sales pipeline managers, customer resource management, and just general valuation. So a lot of good stuff here. Check it out, and I'll see you guys